The current live stock price for Eli Lilly and Company, ticker symbol LLY, sits at $1,060.28, with the market currently closed for the weekend. In the most recent trading session, the stock rallied significantly, gaining nearly $17 to close up 1.6%, cementing its historic entry into the exclusive $1 trillion market cap club. Most investors and casual observers look at this price tag and assume they have missed the boat, believing the massive run-up in value is purely a reflection of past success that cannot possibly be sustained. The expectation is that Eli Lilly is just another pharmaceutical giant that got lucky with a weight loss trend and that the bubble is destined to burst as competition heats up. The reality, however, is far more disruptive and terrifying for its competitors. Eli Lilly has effectively stopped being a traditional pharmaceutical company and has begun trading with the velocity and premium of a high-growth technology asset, decoupling entirely from its peers like Pfizer or Johnson Johnson. While the market obsessed over the initial success of Mounjaro and Zepbound, Eli Lilly was quietly building a defensive moat so wide that even the formidable Novo Nordisk is struggling to keep pace. The stock is not just reacting to sales figures, it is pricing in a fundamental shift in human metabolism management that creates a recurring revenue model similar to the subscription services of Apple stock or the ecosystem stickiness of Tesla stock. When you analyze the intraday movements leading up to this $1 trillion milestone, you see a distinct lack of selling pressure that usually accompanies all-time highs. Typically, when a stock reaches a psychological barrier like $1,000 or a round market cap number, institutional investors initiate profit-taking protocols to rebalance their portfolios. We saw the opposite occur here. As the price approached the $1,050 level, volume accelerated, indicating that major funds, likely those managing Fidelity mutual funds or Schwab Intelligent portfolios, were aggressively adding to positions rather than trimming them. This suggests a consensus among the smart money that the current valuation is not a ceiling, but a new floor. The divergence between Eli Lilly and Novo Nordisk over the last 6 months is particularly telling. While Novo has struggled with supply chain bottlenecks and concerns over the long-term compounding growth of Wegovy, Lilly has demonstrated a manufacturing agility that has allowed it to capture market share at a rate that defies standard pharmaceutical launch curves. The narrative driving this price action is complex, so let's strip it down. The general public believes the weight loss drug market is a duopoly that will eventually be commoditized, driving prices down and crushing margins. That is the expectation. The reality is that Eli Lilly is preparing to launch a next-generation oral GLP-1 agonist, orforglipron, which shifts the entire paradigm from an injectable luxury to a mass-market daily pill. This transition is comparable to Netflix, shifting from DVD mailers to streaming. It changes the accessibility and scale of the addressable market by an order of magnitude. If you are currently using a Robinhood app or an Interactive Brokers account to trade, you need to look at the volume spikes on days when clinical trial data for their oral candidates leaks or is officially released. The market reacts violently because an oral pill removes the friction of needles, potentially expanding the user base from millions to hundreds of millions globally. Let's look closer at the recent Q3 2025 earnings, which provided the fuel for this latest leg up. Revenue came in at a staggering level, but what really matters is the composition of that revenue. The growth is not coming from price hikes, which is the old pharma playbook. It is coming from pure volume expansion and the stickiness of the patient base. Retention rates for Zepbound are proving to be significantly higher than legacy analysts predicted. When a consumer starts on a Fidelity trading platform or opens a SoFi Invest account, they tend to stay. Similarly, patients starting on Lilly's dual agonist therapies are showing immense reluctance to switch off, creating a lifetime value per patient that justifies a tech-like multiple. The price-to-earnings ratio is high, yes, hovering over 50, but if you normalize for the growth rate, the PEG ratio, price, earnings to growth, remains attractive compared to the bloated valuations seen in some sectors of the AI trade. It is critical to discuss the broader market environment because no stock trades in a vacuum. We are seeing a rotation where capital is fleeing cyclical sectors and parking itself in growth at a reasonable price, or GARP. For a long time, NVIDIA stock held the crown as the only must-own growth asset. Now, portfolio managers are treating Eli Lilly as the healthcare equivalent of NVIDIA, a company with a technological lead, in this case biological technology, that competitors are years away from replicating. This is why you see such intense interest on platforms like Fidelity Wealth Management and among users of Robinhood Crypto, who are looking to diversify into high-beta equities. The correlation between LLY and the broader S&P 500 has weakened, meaning it's marching to the beat of its own drum, driven by clinical trial data readouts and prescription script numbers rather than interest rate fears or geopolitical tension. This brings us to the business model itself, which is often misunderstood. Most people think of Lilly as a diabetes company. That is a dangerous oversimplification. The company is effectively a specialized engineering firm for human metabolism and neurology. Beyond the GLP-1 franchise, their work in Alzheimer's with Kisunla donanemab has opened a second massive front for revenue. The approval and launch of Kisunla faced hurdles, but the uptake is beginning to mirror the early days of their obesity portfolio. The expectation was that Alzheimer's treatments are too difficult, too risky, and too controversial to be profitable. The reality is that even a modest penetration into this desperate and underserved market generates billions in free cash flow. This diversification reduces the risk profile of the stock significantly. If you hold Tesla stock, you worry about EV demand. If you hold Apple stock, you worry about iPhone cycles. With Lilly, if the obesity market slows, the Alzheimer's segment picks up the slack, and vice versa. Speaking of holding, I want to hear from you right now. Comment below how many shares of Eli Lilly you currently hold, or if you're waiting for a pullback to start a position. Do you think the $1,000 price tag is too psychological a barrier for retail investors? Or does it signal strength? Let me know your thoughts. Now, we must address the risks, because blindly buying a stock at all-time highs is a quick way to destroy a Schwab Intelligent portfolio. The primary risk for Eli Lilly is not competition, but political intervention. As the first healthcare company to cross the $1 trillion threshold, it paints a massive target on its back for regulators and lawmakers who are concerned about the cost of healthcare. The United States government is under immense pressure to negotiate drug prices downward. If legislation is introduced that specifically caps the annual cost of obesity medications, Lilly's margin profile would compress overnight. We saw a glimpse of this fear earlier in the year, when legislative rumbles caused a sharp 5% drawdown in a single afternoon. Investors using Interactive Broker's stock trading algorithms likely saw stop losses triggered during that event. You must remain vigilant about the political headlines coming out of Washington, D.C., as they pose a greater threat to your gains than any scientist at a rival lab. Another area to watch is the manufacturing ramp. Lilly has committed billions to build new facilities in Indiana, North Carolina, and Europe. This is a massive capital expenditure cycle. While they have plenty of cash from operations to fund this, execution risk is real. Building sterile injectable manufacturing plants is not like building a warehouse for Amazon. It is highly technical and prone to regulatory delays. Any news of an FDA inspection letter or a delay in plant certification could cause the stock to retrace back toward the 900 level. Investors using SoFi Active Investing or similar agile platforms should watch for news regarding 483 observations from the FDA, which is industry speak for manufacturing problems. However, the future outlook remains aggressively positive. The blue sky scenario that bulls are betting on involves the expansion of GLP-1 drugs into entirely new indications. We are seeing early data suggesting these drugs help with sleep apnea, liver disease, NASH, and even cardiovascular health. If Zepbound gets approved for covered treatment of heart disease or addiction, the addressable market effectively doubles again. This is the Apple services moment for Lilly, where the hardware, the drug, becomes a platform for treating multiple conditions. This potentiality is what keeps the PE ratio elevated. The market is pricing in the probability that Lilly cures or manages a vast swath of chronic human ailments with a single chemical backbone. Furthermore, we can